So, Daniel, we are almost halfway through the year, and we're seeing that the Russia-Ukraine war is still having quite significant impacts on many of our economies. What are your views going into the second half of the year?
The key one is that we still believe inflation will be a problem. There is a growing view that potentially inflation has peaked during the first half of the year across most of your developed markets or developed economies. I don't think that is necessarily true for a lot of emerging markets. And informing this is the fact that we're still seeing increases across broader oil prices, and that translates into fuel pump prices in our domestic markets. Significant price hikes across your food baskets. And then more importantly, the inflation expectations is growing for a lot of businesses. So if you think early on this year, PMI across most of our economies was well above 50. There was an excitement coming out of this pandemic period where we're going to enter a growth spurt, so to speak, over the next few years. And a lot of businesses were excited around that. And they revealed during the surveys that we're seeing demand coming into the market. We're ramping up production. Now they're having to deal with a 10 to 15% increase across their input costs, in addition to what they already dealt with during the pandemic. And they're trying to, of course, as one would, you'll see that translation going immediately to the consumer through pricing. And I think this theme of inflation being higher for longer is definitely something that I've baked into a lot of our forecasts for the second half of the year.
Yeah, there certainly is a view that inflation is not transitory, as we thought last year, and that inflation will definitely remain higher for longer.
Sure.
But what is the implication on growth? How has that affected your growth forecast and your views on growth for many of our key African economies?
Again, first half of the year, I was of the view that export-led growth will be what will carry a lot of these economies into your 4%, 5% growth over the sort of short to medium term. That hasn't changed to a great extent, but it has been tweaked. And what I mean by this, firstly, your import bill across most of our markets is looking considerably different because of the amount of fuel that countries have to import. Bulk of our economies, as you're well aware, are net importers of oil. So that's the first problem. Secondly, with high inflation, it's starting to have an impact on consumers and whether or not they're going to be spending to the extent that they were. And I think that's why through our high frequency data, we're hearing a lot of businesses telling us that demand is slowly being diminished from the market. It's not as robust or as strong as they thought it would be. And that has then pretty much halted this, strong recovery that we expected to see. And so growth is not going to be, your 4 or 5% easy-go-lucky type of scenario anymore. I think it's a situation now where we're dealing with few sectors potentially growing, but then having a long period of time before our consumers actually recover.
Yeah. So most central banks react to inflation through interest rates.
Yeah.
Do you also expect interest rate hikes in a lot of our key economies?
Look, unfortunately, this is something that has already started. And I keep saying unfortunately because they're having to hike interest rates at a time when really, accommodative monetary policy probably would have been more suited given the frailty of the various economies. But yes, we're dealing with hikes that are north of 200 to 300 basis points in different markets. And this will be a key challenge. The obvious reason, of course, a lot of them are protected against capital outflows. A lot of these markets are also trying to protect the currency to the extent that they can. The subsequent impact on that, again, not to overextend the topic, really beating a dead horse here, but really the impact on the consumer is becoming even more aggressive because now they have to deal with significantly higher interest rates.
Yeah.
Notwithstanding, of course, there is also a spillover effect on the fiscal side, given that, across the curve, we've seen it become more expensive for governments to do their funding, especially if they're sourcing this domestically.
Yeah. So Daniel, we're seeing high inflation rates, low growth, and there's a view that probably monetary policy has reached its limits, so that monetary policy alone is not sufficient. Yeah. What is the role of fiscal policy in all of this, given all these developments?
It's going to be very difficult for a lot of our governments, Rusa. They were supposed to be entering this period of deep fiscal consolidation. They've ramped up debt during the pandemic, and now it is supposed to be this period where we consolidate. And we'd started seeing a lot of governments actually produce numbers where expenditure growth is relatively mute, and they've been quite conservative around revenue. Now that you're dealing with all of this, it's become quite typical then that, people then start relying a lot more on fiscal policy. And I do think this will be a challenge for a lot of markets because there isn't that much room. There isn't that much fiscal space to begin with. and the impact that that will have on your interest rate expense, if you do ramp up massive budget deficits over the next few years, could become a problem 5 years from now, 10 years from now. And some different economies are in different parts of the scale. But the long and short of it, there will likely be a reliance more on fiscal, but there isn't that much room to actually extend this. And I think the idea, I guess, is people are going to have to just try and weather this storm to the best ability, or to the best that they can over the next few years.